Hello class. So I thought I would take a quick opportunity to review our capital budgeting case. So everyone seemed to do really well with the mini case, but the mini case gave you cash outlay year 0 and then the inflows years 1 through 4, etc., which was fine. But here's the thing. If you are consulting, your client will not give you a nice spreadsheet with these numbers. You're going to have information like we have in the Indian River citrus case. So it's our responsibility to pull out the relevant costs and revenues to develop those numbers that we will then calculate as a present value, internal rate of return, and so on. So I posted a template on Blackboard, which I hope will help. Some of the things that I noticed that need to be corrected. So, first of all, year 0. Year 0 for any capital budgeting analysis is the year in which the company makes the cash investment. So for our purposes, you needed to add together all the costs to get the equipment, shipping, installation, etc. And that's a negative outflow in year 0. The other negative outflow in year 0 was the amount of money that the company said they needed to invest for working capital. So that amount and the equipment purchase are your two negative amounts for year 0. There are no sales in year 0. For the homework that was due yesterday, the sales stayed the same for all 4 years. The costs stay the same for all 4 years. So what you're going to do is you're going to have your sales each year, right? You're going to have your cost of goods sold each year. You're going to have your depreciation using the percentages, and you're going to have the cost of the lost sales. So they told you in the problem that the sales manager feels that certain sales, people who bought regular orange juice will now not buy that and buy light orange juice. So that, of course, is a cost that should be associated with the light orange juice case. So you're going to take those amounts, as in the template, and create an income statement. Now in year 4, just to point this out, in year 4, you're also going to have income come in from the salvage value of the equipment, which I recall was $100,000. So every year now you're going to calculate income before taxes, net income. What are we going to add back? Non-cash expense. What is that? Depreciation. So you already have your year 0, because we already talked about that. For the other years, you're going to be adding back depreciation. And for year 4, just to point out, you're also going to add back that working capital investment, because now the project will end. So the $10,000 that the company needed to invest now comes back. So it's just a wash with the $10,000. You have a $10,000 minus in year 0, and you have it coming back in year 4. And you're going to use those 5 amounts just like you would have in the mini case. You're going to have a negative amount for year 0, and you're going to have positive amounts for years 1 through 4. And then you will apply your present value, and I would use the present value Excel function to come up with the net present value for this project. The right number is $23,000. You will also calculate, and again, you want to use the Excel function for internal rate of return, which is going to be 11.9%, and the modified internal rate of return, which is 11.1%. The cost of capital given in this problem is 10%, and that's the amount you're going to use for the modified internal rate of return. And the last thing you're going to calculate is your discounted payback. And so for that, you're going to simply start subtracting. You've got your negative number for amount for year 0, and then you're going to start chipping away using present values to see how many years it takes to actually pay for that initial investment. Now the homework for today is to add to our model and add inflation. So inflation, so you have inflation at 5%. So you're going to add that 5% starting in year 1. So the sales price is going to go up by 5% in year 1 because this was year 0 when we had the amounts. And the same for the cost of sales. And each year it will go up another 5%. So now your model will have inflation, and your sales numbers and your cost of goods sold numbers will change each year. So it's important that my recommendation is to always take the original model that you do, make a copy, and create that as a separate tab so that you can add more to it. And we will add more to these as we go along because there's actually a second part of this case. So I hope that helps. I think this is a really good case because it makes you think about all the relevant decisions that have to be made for a capital budgeting project. And I can tell you from my managerial accounting course, it's only number crunching. But the reality is that realizing what costs are relevant and which ones are not, and creating a model is really the benefit and the value of this course and this particular part of the course. So I hope everybody's doing well, and I will talk to you all soon. Have a great day.